Well, welcome to our webinar, Ways to Give, Exploring Tax-Efficient Generosity Strategies. My name is Tim McLaughlin, and I sure do appreciate everyone taking a minute out of their schedule today to join. We typically do these over the lunch hour to help our clients who are in the workforce, and typically they can take a break and join us for an educational series like this. Overall, the webinars that we have done, we have not yet done one on giving strategies. So we are excited today to dive deeper into that topic. And really, it's a timely topic because if you can believe it, in just a couple weeks here, we will only have one final quarter remaining of 2025. And of course, many giving strategies are tied closely to the calendar year date timeframe. And so we want to be cognizant of that as we go through and help all of you with those giving strategies. So today, what we get to do is just hear a little bit more about a couple office updates that I will provide to you. And then I will turn it over to Collin Miller, our Director of Planning, and he will walk us through what's going on in the financial markets as well as the economy right now, as we always like to touch base on that during our webinar series. And then we will dive into our main topic. Collin will introduce our guest speaker today, Matt Farmer. He is with the National Christian Foundation, and Collin will provide his formal intro here in just a few minutes. But I've actually had a chance to see Matt now 3 days running. In person the last 2 days, today virtually via our webinar, but we just happened to be at the same community events here. He had made his way up from Kansas City. Of course, we have a contingent of our Kansas City clients on the call as well today, so we're well represented. A lot of Chiefs fans. We're still waiting for that win if you're a Chiefs fan, but it's going to come. I know it is. It's going to come one of these times. It could be worse. You know, you could be a Cowboys fan like Collin. I always give him a hard time, but they got the win last week too. So, but he's always kind of complaining about the decisions made by leadership. So we'll see if they can get it turned around too. But that's actually not the last NFL tie of our call today. So more on that in just a second. And then, of course, at the end, we will have time for questions and answers. As we do during all of our events, whether they are webinars or in-person events, we have a charity partner. And so thanks to the great work that our charity committee does here on site in Des Moines, they help identify charities, whether they be local or national. Oftentimes they're local, either here in Des Moines or in communities that we are serving around the United States. But today we get to partner with Rising Kites, an organization that is on a mission to celebrate the gift of Down syndrome by bringing encouragement, resources, and support to those within the Down syndrome community. And we actually have one of our clients here in the Des Moines area. This organization is near and dear to her heart. Her brother had Down syndrome when he was alive and has passed on recently in recent years. And so we wanted to definitely honor this organization, and as well as we do many others. So if you have an organization that you would like to bring to our attention, please send it our way. We do have a formal process whereby we take an application from the organization, and that way we can make sure that we're considering all factors. We, of course, receive a lot of those requests, but we do want to say a thank you again to you for spending your time today here with us. That allows us to support these charity partner organizations. We tie our support to the number of attendees that we have either on our webinars or physical attendees at our events. So thank you again for partnering with us as we support today's events organization, Rising Kites. Well, next, let's take a look in a little bit more detail, of course, on questions. If you have a question, please email that to info@harvestpointwm.com. That's the best way for us to include that question during today's webinar. So if you just have your email account open, and as we're going today, if you think of a question, send it to that email address. We would take it on the Zoom call here today if we could, but our compliance department has disabled that use just for compliance reasons. So the best way to do it would be just to send that email to info@harvestpointwm.com. And we've received a couple questions already to that email address. Since that's a common occurrence during our webinars, we use that email to collect the questions. So please please be sure to do that. By way of an office update, you probably have received a mailing from Macquarie or Nomura in recent weeks or months. In most cases, that mailing has said urgent or needs your attention. They make that very clear right on there. And so I know we've spoken with a number of you about this. This is a legitimate mailing. So in today's day and age of scams and fraudulent mailings that we're constantly trying to warn you about, this one actually is legitimate. And really it just simply involves the acquisition of a fund company, and many of those funds are impacted. Of course, many of our clients own a couple of those funds in particular, and so they are needing to acquire the necessary votes in order to have that transaction go through. So again, for regulatory reasons, we are not able to tell you which way to vote with that particular transaction that's occurring or merger, but we certainly are happy to speak with you more about that to provide you some more details, as well as walk through the options that you have. One important note is that if you do vote, regardless of how you vote, those inquiries, whether they be via mail or telephone or email, they will cease, is what we have been told. Sometimes it takes a day or two, maybe even a week, for the systems to line up and for you to kind of fall off of their lists once you do vote. But thank you for bearing with us. We know that's never any fun when you get your mailbox inundated with letters. And of course, they have to send that out on a per account and per fund basis. So I've seen the stacks. I've seen the pictures of the letters. I've gone into clients' homes and helped talk them through that. So again, if you have any questions at all on this, please don't hesitate to reach out. This is not an uncommon occurrence. Over the years, this happens occasionally from time to time, but we're here to provide information and talk through that with you. So thank you for bearing with us in that regard. Well, the next time that you are in our Des Moines office, Angela and Lauren have put up a beautiful map of the world in our conference room. So many of you, again, have seen that maybe in recent meetings, but what's kind of fun about this map is it is interactive in the sense that we have little pins that we can stick into locations where you have recently traveled. And it's a neat way for us to see how many of our clients are getting to see the world and then hear those stories as well. And of course, we always love seeing your pictures too, that we have kind of scrolling in our lobby on the television there. So if you're in the neighborhood, please don't hesitate to stop in and check out our awesome map and maybe find a location to put your pin in. And we'd love to hear your stories. Well, as you know, Harvest Point exists to faithfully guide and equip our clients to wisely steward the wealth that has been entrusted to them. And of course, we have guests on the call today, so I always like to spend just a minute giving a little bit more background about Harvest Point and maybe what we're all about here as a firm. We are blessed and fortunate to have a 98% client retention ratio. And again, that's thanks to, in many cases, decades-long running relationships that we have with you as our clients. We have 72 plus years combined financial industry experience, family owned and operated. And really, when it comes down to it, we like to say that we're personalized, comprehensive, and faith-driven here at Harvest Point. You'll see here our people, the people of Harvest Point. Many of these folks you know, if you've been around our firm for any period of time. These are some of my favorite people in the world, and I get to come to work every day and serve our great clients with them. So, of course, Angela is typically your first point of contact when you call in or email. And so don't hesitate to reach out to her. Cameron is our client service specialist. He is actually getting married on Saturday. So congratulations to Cameron. And then another exciting announcement, Lauren Wegman is engaged to be married next August to her fiance. And then also, I think probably since the last time we had a webinar, Jacob and his wife had a daughter. So there's been lots of things to celebrate here at Harvest Point in terms of big life events. And we're always excited to do just that. Well, again, for the purpose of our guests on the call, or even if you're a client and you might have someone in your life that might want to find out more about our firm, you can feel free to scan the QR code on the left there on the screen, and it will take you right to our discovery questionnaire. That's a great starting point to just kind of get your information into our systems. And then it allows us, of course, to reach out and schedule an introductory call to see if we could learn a little bit more about you. And of course, share with you a little bit more about our firm with the purpose of determining if it would make sense to work together. On the right, you will see another QR code. That would be to leave us a review. We've been so blessed in recent years to receive a number of those from our existing clients, just sharing a bit more about their experience and what it's like to work with Harvest Point. So thank you genuinely from the bottom of our hearts. That means a lot to us. Likewise, we've been sending out a survey in recent months, and we really appreciate the high response rate that we have received there and a lot of wonderful comments. So again, that leave a review section just helps prospective clients have a little bit of a better idea of what it's like to work with Harvest Point. You can scan that QR code. As we like to say, the client is the most important person in our company, and everything we do has the client at the center. We are here to serve you, and that is never lost on us. We always want to hear if for some reason we're missing the mark on that, just like I was just mentioning on the positive experiences. Of course, if we drop the ball, we want to hear about that. We're always trying to improve and grow in the way that we serve you. Well, with that said, let me introduce Collin Miller, our Director of Planning here at Harvest Point, and he's going to give us a little bit more of an update or background on what is going on in the financial markets and the economy right now. Collin?
Thanks, Tim. The only thing I have to say about the Cowboys is at least we have a win this year so far. So I don't know how much longer that'll last. It seems like right about now, every year, we're second guessing the Chiefs, and we usually say they're just not going to make a run this year. I think it'll still happen for you Kansas City folks. So congratulations on a good, 3 or 4 years now as Chiefs fans. It's got to feel pretty good. Like Tim mentioned, I wanted to spend just a few moments today just discussing where we think the market's at and where we kind of think we can be heading. So this next slide that we're going to look at is shows 8 different instances across our history when the S&P 500 returns more than 1% in the month of August. And we also have 5 all-time highs throughout the course of that month as well. So that, as you can see, has happened 8 times dating back to 1961. And when we look at this chart, it shows that on average, the month of September is usually negative when those 2 instances occur. So dating back to 1961, if you look at all those September returns, that averages to be a negative 2.3% return. But so far this year, it's a little different. As of the close of business yesterday, the S&P 500 is actually up 3.5% in the month of September. And so far year to date, we're up over 13%. So hopefully we can see this trend continue for the rest of the month. And hopefully we can have the first positive September month that we've seen when August has been also good. Next chart that we have here just kind of looks at what has happened when we have strong performance from the S&P 500. So if we look back to April 7th of this year, between April 7th and August 28th, we experienced over 25% growth on the S&P 500 in 100 business days. And that has happened a handful of times throughout history, dating back to 1950. You can see that it's happened there 11 different times. And I'm not going to worry too much about the 1 month, 3 month, or 6 month figures because we all know we're longer term investors than that. But if you look out at the 12-month returns after we've had a 25% gain in 100 days, it's an average of about 12.9% the following 12 months. When you compare that to what the S&P 500 does on an annual basis outside of that, it's usually about 9.2% each year. So hopefully that's a good indicator for us to see that there's still some room to grow in this market. Only once throughout history, back in 1987, had we had a negative return after we had a 25% gain in 100 days. This last slide that I'm going to share with you is just kind of an overall snapshot of where some analysts that we partner with think we are from a financial indicator, economic indicator standpoint. So on the left there, you can see different financial and economic indicators, and the folks over at Franklin Templeton have taken the time to kind of analyze where they think we're at, what from either an expansionary, cautionary, or recessionary territory for each. So you see a lot of green in the current markings, which is a good thing to see. And you can kind of tell throughout history, all those other red X's to the right are different recessionary years. So the third column there is 2007 to 2009. That was the '08 financial crisis. You can see there's a lot of recessionary indicators there. The tech bubble of '01, the early '90s, early '80s, and so on. But one thing I want to draw your attention to is 2020. So you can see there's some similarities between 2020 and now. And if you recall back to 2020, we actually had a major dip in the S&P 500 between the months of February and March when the coronavirus first started spreading and we were all working from home and social distancing. But in February and March of 2020, the S&P 500 dipped almost 31% from its most recent all-time high. And yet, 2020, the total return on the S&P 500 for the year was 16%. So far this year, when we look from January 1st to April 7th, the S&P 500 was down 15%. And so far, like I mentioned earlier, we've returned over 13%. So a lot of similarities between this year and 2020. Both were different, extraordinary events between coronavirus and the tariffs and what's going on overseas too. So hopefully, like we've said, there's some room to run. We wouldn't be surprised, though, at the same time, if we see a pullback. That's what happens when there's a healthy economy. You see sustained periods of good, solid growth, but then every once in a while, you need somewhat of a correction or a dip in the market so the economy can somewhat reset. The fund managers can go do their job and be active on the funds for you. So if you have any questions about where we think the economy is headed or what you think about your risk in your accounts, feel free to reach out to us. We'd be happy to have that conversation one-on-one with you. And I think there's a couple of questions that we've already received from folks at the end of the call about what just happened yesterday with the interest rate cut. So we'll address that later in the call. Before I turn it over to Matt, I wanted to set the stage for our presentation that he's going to be giving about giving. And I wanted to start this off with a passage from the book of Mark. Mark chapter 12, verses 41 through 44 says, Jesus sat down opposite the place where the offerings were put and watched the crowd putting their money into the temple treasury. Many rich people threw in large amounts, but a poor widow came in and put in 2 very small copper coins, worth only a few cents. Calling his disciples to him, Jesus said, Truly, I tell you, this poor widow has put more into the treasury than all the others. They all gave out of their wealth, but she, out of her poverty, put in everything, all she had to live on. When I hear and read this verse, I think of a couple of things. First off, God measures your heart, not the amount you give. The widow had 2 coins to give, and that looked insignificant compared to the larger gifts. Yet, Jesus praised her because her giving reflected her trust in God. Secondly, true generosity involves trust, both in yourself and in God. Giving often requires faith and a willingness to trust God with our future rather than holding tightly to what feels safe. And finally, God values faithfulness over applause. The rich may have been noticed for their larger gifts, but Jesus highlighted the unseen and faithful act of the widow. In our giving, we should not be motivated by recognition or comparison, but by faithfulness to God's calling. Now I'd like to introduce our guest speaker, Matt Farmer. Matt joined the National Christian Foundation in 2019 as Vice President of NCF Heartland in Overland Park, Kansas, and in 2022, he transitioned to the role of President. Matt and the Heartland team lead a 6-state regional effort focused on catalyzed biblical generosity by serving as a family office for giving. He's an MBA graduate of Washington University in St. Louis, go Cardinals. He also holds a Master of Divinity degree from Denver Seminary and a Bachelor of Science degree in Social Sciences from the U.S. Air Force Academy, followed by 12 years of service in the U.S. Air Force. Currently, Matt also serves as the chapel leader for the Kansas City Royals. His sports career also includes a 2-year stint as a receiver and punt returner for the New York Jets. He and his wife, Jenna, currently live in Kansas City with their 3 boys and their sheepadoodle, Maisie. Turn it over to you, Matt.
Thanks, Colin. Trying to get my video going. So if you guys can do that for me, that'd be great. But if not, you can see a picture of my family there. So that's Jenna and our 3 boys, 12, 10, and 7 years old, and our beautiful sheepadoodle. It's a privilege to be with you guys. One thing that wasn't mentioned on my short bio was that I am a fellow Iowegian. So grew up in Iowa, grew up in Pella. My parents are up in Des Moines. My sister lives in Johnston. So for you Kansas Cityans, I now live near you, but have some history up there in what some call heaven, but it is just Iowa. So grateful to be here. Fun to hear the updates about you and your team. Tim, it's an honor to be on the call today, and just a little bit higher level kind of overview of NCF, the National Christian Foundation. So we have been around for 42 years. And in those 42 years, we've helped leverage a bunch of generosity, mostly through the tool of a donor advised fund. But in terms of gifts in, so we've received over $25 billion with a B in gifts to donor advised funds in our 42 years. And then the best part is we have watched over $20 billion with a B go right back out the door to charities, churches all over the globe and across the street and local communities. And one of the fun parts about the work that we get to do is almost every year, the number one recipient of the grants from donor advised funds at NCF is the local church. And so we really believe strongly that the local church is a key ingredient to seeing the gospel move forward. And so it's fun to be part of an organization that helps leverage generosity to get dollars into and through local churches. So we really help folks at the ground level develop giving strategies. Lots of folks have financial strategies. That's what Tim, Collin, they're here to do. They really help you all with that. And then we love to come alongside advisor firms and provide some of the giving strategy work so that folks can pay less in taxes and experience the joy of generosity. And we'll talk a little bit more about that here in a moment. So our mission at NCF is to mobilize resources by inspiring biblical generosity. One of the things that we remember, Jesus, he said to his people that Paul quoted him in Acts. He said, the master said, you're far happier giving than getting. Or Jesus said, it's more blessed to receive, more blessed to give than to receive. And if you translate that literally, it could be translated, it is more happy making to give than to receive. And so we love helping to mobilize these resources and increasing the joy that folks get to experience as they give their resources away. NCF by the numbers, I talked through some of the highlights, 90,000 plus charities supported since we've been around in 1982. Again, $27 billion contributed into NCF, $21 billion out of NCF. And then we won't talk a lot about this, but one of the key strategies is non-cash giving. That could be publicly traded securities and other things. And we've helped facilitate over $6 billion in that arena as well. So big question, right? We could spend the rest of our time answering what does the Bible say about generosity. I think one of the key passages about ownership generally, as we ask the question, who owns it all, we find a great answer in Psalm 24:1, and it says this, it says, the earth and everything in it, the world and its inhabitants belong to the Lord. For he laid its foundation on the seas and established it on the rivers. And what we know from these two verses, what it's stating really clearly is that God owns it all. We are not the owners. And one of the key principles of Scripture is that we are stewards of what God owns. God invites us to steward the resources he has entrusted to us, and he invites us to be generous with the resources that he's given us. And so one of the things the Bible says is that we're to remember that we are not the owners, we are the stewards. Collin alluded to this in the passage about the widow, that God doesn't need our money. That's another thing the Bible says about generosity. When we're generous, it's not because God needs our money. God wants our hearts. And so our generosity helps change our hearts. And that's one of the reasons why giving matters, right? We love this phrase. Pastor Chip Ingram, he loves to say, generosity is a gateway into intimacy with God. So we believe that how we use our finances, what decisions we make around our generosity and our giving will grow our intimacy with God. Secondly, it also matters because it helps us become more like Jesus. If one of the goals of the Christian life is to become more and more like Jesus, Jesus was the most generous person that lived, at least as it relates to giving his life on our behalf, right? The Father sent his Son. He gave his Son on behalf of us, for our sins. And Jesus offered his life for us. He made the ultimate sacrifice. And the invitation is to be that generous, be conduits of that kind of generosity with the resources that God has entrusted to us. Jesus told us, where your treasure is, there your heart will be also. That's why giving matters. Where our money goes is where our heart flows, right? So we want to be generous toward those things that God actually cares about. As we think about what are those things, what are the things that our generosity can support? And as we read through scripture, there's lots and lots of verses, a couple thousand verses and more around those in need, the marginalized, the oppressed, the orphan, the widow. So one of the invitations of biblical generosity is to give to those who are in need. Psalm 19:17 or Proverbs 19:17 tells us that those who are kind to the poor lend to the Lord. So there is this sense in which when we are generous toward the poor, when we are generous toward the needy, we are offering praise, we are offering worship, we are lending, we are giving on behalf of the Lord. Another thing that giving supports is multi-generational generosity. One of the things that we love to do is come alongside families that are multi-generational, dreaming about, thinking about what does generosity looks like across generations. And part of what that means is how do we do family giving that promotes unity and not disunity? How do we talk about generosity? How do we tell the story of our family in a way that crafts an enduring legacy, that shares the story of what God has been doing in and through the story of our family? And then finally, we believe that legacy starts now. Legacy is not something that happens when we're dead. We're all writing our legacy today as we write it in our relationships and the decisions we make and the things that we do. And then finally, the gospel. Our giving supports the Great Commission, the idea that and the fact that the gospel changes lives. The good news of Jesus changes lives, changes communities, changes countries. And so our giving fuels that generosity. Jesus invited his first followers before he left this earth to go and make disciples in Jerusalem, Judea, and to the ends of the earth. And one great strategy around our giving is, what does giving look like in Jerusalem? What does it look like in our local context? Secondly, what does our giving look like in Judea, in the region, maybe in our state? And then what does giving look like to the ends of the earth? What kinds of giving are we doing that's global, that's getting the message of the gospel to the ends of the earth? So 3 things that our giving supports. And there's really some practical benefits to generosity too. Like it can help make our tax experience more efficient. And we can leverage those resources. We use the phrase kind of converting tax dollars to giving dollars, and that's what generosity can do when we're strategic about it. So a couple just kind of highlights around generosity and tax efficiency. Our generosity can help reduce our adjusted gross income, and that can be a complicated calculation, but essentially it's all of our income before we take a standard deduction or an itemized deduction. And depending on what kinds of generosity we're doing, what kind of giving we're thinking about in our specific situation, where we're at on the age timeline even, we can reduce our Medicare brackets. We can also reduce our net investment income tax exposure, which really is at a high level. It's a tax that applies to high income individuals, estates, and trusts with investment income. And then as it relates to itemized deductions versus standard deduction, pretty straightforward, right? Standard deduction is what you can get if you just claim kind of standard. Hey, I think in 2025, it's a little bit over $31,000, almost $32,000. You can take that standard deduction, or if your real estate taxes, your mortgage insurance, mortgage interest, and then your charitable deductions, if those kind of exceed the standard deduction, then it probably would make sense to itemize your deductions and not take the standard deduction. One strategy, as you think about if our itemized deductions aren't quite to the standard deduction level, one strategy we've been recommending, and I know a lot of financial advisors will recommend this, is this idea of bunching donations. And high income years, or even just regular income years, if you're close to that threshold. And what that means is you're just bunching your charitable contributions every 2 years. It could be every 3 years, but you're doubling your charitable contributions to get you above that standard deduction threshold to maximize your tax efficiency that year. And then as you move to the next year, you'll take the standard deduction. You might do a little bit less charitable contributions, and that way you're maximizing your efficiency the following year. And then you can do that, then bunch it again the next year in a revolving way. Of course, plan that out with your financial advisor, CPA, but that's generally how this strategy works. And then we love working with business owners, real estate owners. If you're having a business sale in a particular year, you've got a windfall, some kind of a retirement transition, if you've got money coming in or a liquidity event coming, there are some really creative ways you can think about gifting some of those proceeds, especially around a business sale, real estate sale. You can gift some of that before the sale actually happens and really minimize tax exposure, maximize your charitable giving, getting more dollars out to the charities and organizations that you love to support. So really practically, some different kinds of giving vehicles that we will cover today, mostly at a really high level. Before we take some questions, we'll cover irrevocable trusts, we'll cover donor advised funds, qualified charitable distributions, publicly traded securities, donating those, and then cash donations and gifts. And then finally, life acronym that we'll walk through at the very end. So donor advised funds, we'll start here. So donor advised funds, it's the fastest growing charitable giving vehicle and has been probably for the last, I think, 15 years or so. Essentially what a donor advised fund is, we call it a charitable checking account or a charitable investment account for giving, as it's listed here. Essentially, you can make contributions in 2025, you make contributions into the fund, you get a tax deduction for that gift in 2025. It goes into the fund. It can grow as an investment tax-free. And then when you're ready, you can either give it away in 2025 or you can give it some away in 2025, give some of it away in 2026 to any public charity that's approved by the IRS, whether that's, that your local church down the road, it's something there local in Des Moines, Kansas City, wherever you might be located. Those assets can grow tax-free. And so we use this kind of 3-word phrase. If you give into the fund, it can grow tax-free, and then grant at your convenience, grant as the Lord leads. So give, grow, grant. There's lots of flexibility because you can give it now and you can distribute it over time. One great example, we've talked about the Chiefs, we've talked about the Cowboys. They reference I'm a chaplain for the Royals. So one of the things that especially high income earners, think about a football player who they make almost all of their money in a 6-month time frame, from September when the season starts through January, and it's December, and they've made a good chunk of change, and they want to make a charitable gift. They want to make a charitable contribution to an organization or multiple organizations, but they're busy. They're in the middle of the season. They're not sure what to do. So donor advised fund has been an incredibly valuable tool where they can make a large donation into the donor advised fund. They get the tax deduction that year, and then they're able to give those dollars away over time. They don't have to feel the pressure of, oh, I've got to make a decision about where these dollars are going right now. They get to say, hey, I'm going to make the contribution now, and over time, I can make the decision. I can pray more about it. I can be more rooted in where God is leading around what kinds of organizations, what are the places he's leading us to move this money to and to invest in. Investing meaning in the sense of we're granting out to organizations that are doing great work and seeing God's kingdom come, God's will be done on earth as it is in heaven, as Jesus invited us to pray. And then one of the other real key benefits of a donor advised fund is you can invite multiple generations into the conversation around family giving. And so we've even jumped into some conversations with advisors and families they serve, asking questions around, we like to phrase it this way, we giving versus me giving. This idea that, typically, whoever opened the donor advised fund, they're generating the most resources, generating the most income. Most of the dollars are going in and through the donor advised fund through them, but they're wanting to invite some we giving from either their kids or their grandkids. And so they're saying, hey, we've got this donor advised fund. We'd love to pull together a family meeting. We'd love to ask some questions. We'd love to hear what are some of the things that you guys are passionate about. And then doing some of that giving together, thinking through how do we leverage these resources to help bless different organizations doing different things that fulfill their passions, the things that God has led them to care most about. So there's some really cool things that can happen on the family philanthropy side with donor advised funds. Irrevocable trusts, we won't do a deep dive here. I'm not an attorney, though I could play one on TV perhaps. But this is more of an attorney discussion. But what's interesting about irrevocable trusts, it's typically used for larger estates or legacy strategies. Think estate planning. It can provide income to the family or beneficiaries while ensuring an ultimate gift to charity. Think about one way to think about it as a split interest gift. That's another way that you'll hear it described. we're called, and that just means there's a double benefit. The family can get an income stream, the beneficiary can get an income stream, and then ultimately the remainder can go to a charity. It can reduce estate taxes. It may provide some income tax deductions based on the assets that are donated into the trust. And again, it can work well for some complex kind of wealth situations. I think one way to think about this is it really helps folks take advantage of giving opportunities during their lifetime that come to fruition at the end of their life for the charity or for family members. And generally, this happens estate planning, especially when the estate value exceeds the estate tax exemption amounts, and that this year is around $28 million. And so think irrevocable trust come into play if you're in that kind of a situation. You'd want to check in with an attorney on what that looks like and what the best strategy is going to be to fit your situation. Gifts, thinking about cash gifts, this is really the most straightforward. You can give cash gifts straight to charities. You can give a cash gift into a donor advised fund. The most straightforward method, it's deductible up to 60% of your AGI if you're itemizing your deductions. So let's say your adjusted gross income is $100,000. If you were at the place where you could give $60,000 of that away, you could give $60,000 in cash to one charity, multiple charities, and then you could take a deduction for all of that giving in 1 year. So you can deduct up to 60% of that AGI if all that giving is done in cash. It's an immediate impact for organizations. There's some predictability. I think of the organizations that we help support, we do a lot of board work coming alongside nonprofits, helping them think through cash giving, non-cash giving, giving strategies, ways to work well with their donors. They love cash gifts. They love the predictability of cash gifts, right? They're trying to manage a budget. They're trying to plan and prepare, strategize around a budget. And oftentimes this predictable cash giving, monthly giving can be a great way for them to get some consistency and predictability around what that looks like. Some examples we've listed here, obviously the ongoing tithe, 10% of our income, some one-time gifts, annual pledges, things along those lines. Transfer of shares. So this is where we've got some appreciated stocks, appreciated mutual funds. We want to donate those securities. We want to make sure they've been held longer than 1 year. If they're held less than a year, you're only going to get a basis deduction for that gift. We've had some folks make that mistake before, but we want to help folks make sure they're donating securities that have been held longer than 1 year. Helps potentially avoid the capital gains tax. So I'll use Target as an example. We do some shopping at Target. If you were to own some shares of Target, buy them for $100, and a year and a half later they're worth $150, you could donate those shares directly to a charity or to a donor advised fund. It's one of the most common ways people give to a donor advised fund. You would get immediate tax deduction for the value of those shares gifted to the donor advised fund. The donor advised fund provider would liquidate them. NCF, Community Foundation, they would liquidate those shares. There would be no capital gains tax on those shares, and the full fair market value of those would go directly into the fund or directly to the charity that you make the donation to. One of the nuances around non-cash giving, gifts of shares, publicly traded equities, is that you can only deduct up to 30% of your adjusted gross income. So if you are making, to use $100,000 again, if your annual gross income is $100,000, you could make a gift of $30,000 of shares of Target stock and get a $30,000 deduction for your income in that year. If it was over that, let's say you gifted $50,000 of Target stock in 1 year, you could deduct 30% in that year, and then you could roll over the other 20% to the next year. So if you ever give more cash or more non-cash gifts than you're allowed to deduct in 1 year, you can always carry forward what's left over up to 5 more years. So you can take the deduction in year 1, and then you have 5 more years to carry forward that deduction to use it on your taxes. This gift of gifting stock is a great way to leverage highly appreciated assets for maximum impact. We use the phrase multiplying your impact to maximize your giving, but it's a great way to do it. I know Tim and Collin would love to help you do this if you haven't thought through it, or do it again if you've already done it. QCDs, qualified charitable distributions. There is some nuance here. essentially, you can start making QCDs once you are aged 70 and a half or over. One thing to scale back to is once you're 59 and a half, you can start taking regular distributions out of an IRA. You're going to get taxed on those regular distributions, but once you're 59 and a half, you can start taking them. And then when you reach 70 and a half, you can start taking qualified charitable donations, which count toward your required minimum distribution. And you can give up to $100,000 per year per person. And those qualified charitable distributions are excluded from your taxable income. So this is especially powerful for retirees. And those RMDs start kicking in, those required minimum distributions start kicking in at 73. So the QCDs, you can start giving those at age 70 and a half. The RMDs start kicking in at 73. But again, you can gift up to $100,000 per year per person directly to a charity from your IRA. One nuance here that NCF has found a solution for and other community foundations can do, we've created a product or have a product we can provide called a single charity fund or a designated fund. It functions very much like a donor advised fund. Essentially, you can gift cash, you can gift non-cash, you can gift QCDs into this single charity fund or designated fund, and you get a tax deduction, a fair market value tax deduction for that gift. And then the nuance is, instead of giving it to any charity, you have to give it to the single charity that it's set up to grant to, or the designated charity that it's set up to grant to. But this is one way that you can use a fund that functions like a donor advised fund, where once the money goes in, it can grow as a tax-free investment until you give it away. You can do QCDs, you can give QCDs to a single charity fund or a designated fund. One of the reasons people will do that, so instead of giving it directly to your local church or maybe some other charity, one of the reasons folks might do that is they're able to give $100,000, $100,000 QCD, and they're thinking, hey, my church, I'm not sure what my church would do with a $100,000 gift right now. So instead of gifting it to my church, I'm going to open a single charity fund or a designated fund, and I'm going to make that qualified charitable distribution into that single charity fund. It functions the same way like giving it to charity. It won't count towards your taxable income. So it'll sit in the fund. It can grow tax-free as an investment. And then you can give $10,000 to your church. You can give $20,000 to your church. You can give $30,000 to your church. You get to advise how much goes out to your church over time. So all 100,000 of that doesn't land at the church in that year. So there are, situations where a nonprofit or a church, that might be too much. You might feel like it's too much for them to handle at once, or you might not know exactly what they're going to do with it. So you want to open a single charity fund, designated fund, to make that donation there. And then finally, life. This is one of the final things I would say. We know that generosity is not just about money. So when Jesus said it is more happy making to give than to receive, he didn't just mean it's more happy making to give money. He was saying in every way. And what life stands for is labor, influence, finances, and expertise. And I could add a T for testimony. So how are we being generous with our labor? How are we being generous with the work that we're doing and the roles that we have vocationally? How are we being generous with our influence? Each of us has been given influence over a certain amount of folks, over a certain, a specific area of our work. In what ways are we being generous with the influence that we carry, either in our family or in our work? Finances, we've talked a lot about. Expertise, this is a great way to offer generosity. What are some places where you have expertise, where you can step in and help an organization? You can step in and help a needy family. You can step in and help someone that really needs what you can provide, right? And then finally, how can we be generous with our testimony? How can we be generous with what God has done in our life? Generous with declaring what God has done in our life, what God is doing through our life, ways that we've learned about God's provision, and ways that he's invited him to trust him, and ways he's invited us to surrender to him. And then finally, I would say, how is God inviting us to be generous in the ways that we receive? So many times we're in positions of power, or we're in the position of the ones who are being generous. And sometimes we're in seasons of life where God is asking us to be generous recipients. He's inviting us to be generous recipients of others' generosity. And if anyone's like me, my wife, we just went through a season of cancer with her over the last 18 months. And there were some moments when it was really hard for us to receive. It was really hard for us to admit that we were in a place of real need and we needed help from others. And sometimes that's where God has us. And we're in that space where he's inviting us to receive from others. And so how can we be generous with our labor? How can we be generous with our influence, our finances, our expertise, our testimony? And how can we receive the generosity of others in gracious ways?
Wow, thank you so much, Matt. Just a lot to think about, quite frankly, lots of different options and strategies. And we are so grateful for all of your insight, as well as all the important work that the National Christian Foundation is doing. And we're excited to keep our eye on that and continue to partner with you. This quote on the screen came to mind as we were putting together this presentation. It's from Jim Elliot. He's a missionary who gave his life and ended up dying in Ecuador as he took the gospel to an unreached people group. And he said in his journal during his living years, he is no fool who gives what he cannot keep to gain that which he cannot lose. And really, it kind of reminds me of a passage from the book of Matthew. In Matthew 6, it mentions, this is Jesus talking now, it says, "Do not store up for yourselves treasure on earth, where moths and vermin destroy and where thieves break in and steal, but store up for yourselves treasure in heaven, where moths and vermin do not destroy and where thieves do not break in and steal. For where your treasure is, there your heart will be also." I also just happened to read this morning in my daily reading, if riches increase, do not set your heart on them. And of course, for any investors in recent years, we've had really good years. We've had substantial growth, quite frankly, even over the past 8 years inside of just any average or typical investment portfolio. So it's kind of an example there of we've had some great growth, and of course, we don't want to set our hearts on that. And really, generosity is such a great way. Giving is such a great way to break the power that money can potentially have on us, or the hold that it might have on us. So hopefully, you were able to take away some great notes and thoughts from Matt's presentation, in particular, maybe strategies that stuck out to you. Let us know what jumped out to you. We want to hear about that. We want to further the conversation with you to help in any way that we possibly can. And we're always delighted to do that. And really, we get a front row seat to your generosity. I just want to commend not only the clients that are on the call today, but anybody that might watch the replay. It's amazing to see your heart in generosity and giving. And we get to, again, help facilitate that process in many ways. Qualified charitable distributions, donor advised fund. So it's really incredible to see. And we admire you set just such a great example for us, as well as future generations inside of your lives, setting the bar high for generosity standards. So let me now turn to question and answer. So if you haven't had an opportunity yet to get your question in to answer, please do that and send it to info@harvestpointwm.com. I guess. Thank you, Lauren, for putting this slide up. Important dates. We did want to make sure to remind you that if you did have a particular strategy that you wanted to take advantage of, there are some hard deadlines and there are some soft deadlines coming up. Of course, the year-end deadline, we can't go beyond that for any qualified charitable distribution. So December 31st is the final date, cutoff date to make that qualified charitable distribution. We like to get that started no later than December 10th because, as you might imagine, or maybe you've seen personally, sometimes those checks get stuck on charities' desks and in unopened envelopes. And so we want to make sure there's enough time to get that whole process done and recorded properly. And so the sooner the better when it comes to a lot of these strategies. And then really just working backwards, November 15th is another important date, more of a soft date. But that's kind of our target date if there's any complex gifting that you want to take care of or consider prior to the end of the year. So the good news is we have plenty of time to have those conversations, to finalize these strategies. Perhaps maybe you still have some left to take out of your IRA to satisfy your RMD, as Matt was talking about. This could be a good way if you don't need that money this year or in the year coming up here, where you could give it to an organization that is near and dear to your heart. Well, let's flip to questions now, and we do have a couple here. I will make sure I pull those up. Our first question, Matt, is for you, and it is from Sherry here in Iowa. She wanted to know, are qualified charitable distributions the only type of giving that will count towards her required minimum distribution directly?
Great question, Sherry. I am instructed to say check with your CPA, but I will say that my understanding is yes, QCDs are currently the only type of charitable giving that can count directly towards satisfying that RMD from an IRA without being included in your taxable income.
There you go. And that's kind of what makes it such a powerful strategy compared to all others. So yeah, definitely, like Matt said, if you're above the age of 73, you're taking those required minimum distributions. This is a great way to directly offset them. Certainly also, it's kind of an odd, unique window from the age of 70 and a half to 73, where you're not yet required to take money out of the IRA, but yet you can still do the qualified charitable distribution. So those would be the kind of the target ages to watch out for there to further that conversation. Collin, the next question is for you. Brian from Iowa wanted to know, how will the recent interest rate cut affect his current loans?
Yeah, that's a great question. It depends on the type of loan you have. So if you have a traditional fixed interest rate mortgage or car loan, more than likely and more than certainly it won't affect your rates at all. Nothing will change unless you have a current rate that is higher than what you go shop a new rate for. Then you could refinance that loan. You have to weigh out the pros and cons of if that's going to be worth the additional costs to do so. But now if you have a floating rate loan or a variable rate loan, that would be a good thing to check with the loan officer who you took that out with to see if there's anything that you need to look for. Since we've been at recent all-time highs or not all-time highs, recent highs with different interest rates that there are out there, more than likely this 25-point cut's not big enough to make a big drastic change. You'd probably want to see a couple percent or maybe a percent. But always, check with us to see if there's anything we think you could be taking advantage of. Check with the loan officer on any existing rates that you might have out there too.
Perfect. Thank you, Collin. And I'll actually stay with you for this next question. And then I do have one more for Matt as well. Collin, Dan from Missouri just wanted to know, with the recent cut again, will that impact recession risk or have a significant impact there? And we might even have, I think we stuck in a slide just last minute, since it was yesterday when they made that cut. But could you want to address that, Collin?
Yeah, if we can go and flip that slide, Lauren. Thank you. So this has happened before. Obviously, there have been federal rate cuts. And what this chart actually shows us is when there's a federal rate cut within 2% of an all-time high. And you can see going back to 1980, there's been a lot of instances of those two things occurring next to each other. And if we look out 12 months in that far right column, on average, 12 months following that first rate cut or that rate cut, the S&P 500 has been up about 14%. So, and more interestingly enough, 1 year later, the S&P 500 has never been down. Now, this is historical figures. We can't predict the future. We don't have that glass ball that everybody always asks us for. But if history repeats itself, hopefully 12 months from now, we're sitting here talking about a positive return in the market. Obviously, that chart shows the next month is kind of hit or miss what'll happen. Next 3 months, positive more times than not. Same thing with 6 months. But truly, what we're looking at is that next year column, and that shows that 100% of the time when there's been a rate cut within 2% of an all-time high on the S&P 500, we have a positive return 1 year later.
Fantastic. Thank you very much, Collin. I thought you told me you could predict the future. You could look into your crystal ball and say, and I thought you said something about the Chiefs winning the Super Bowl. So I guess we'll have to talk about that after the call. No, I'm just kidding. Okay, Matt, I did have one more for you on that. You called it a single organization fund. Is that what you called it?
Single charity fund or a designated fund.
Is that something that is unique to NCF? Is that offered other places in the industry?
Good question. Yes. It's not unique to NCF necessarily, but yeah, I don't know that all DAF providers offer it, but certainly there are others that do. Yes.
Very
Yep.
good.
They might call it a designated fund. That's why I use both terms. Single charity is what we call it. Others probably would call it a designated fund.
Fantastic. Fantastic. Thank you for clarifying in that
Yep.
regard. I'll just check here. I don't think we have any other questions that have come in. Oh, I'm sorry. We do have one more that just came in. So Lois in Iowa wanted to know, are cash donations to charities deductible if you do not itemize? You're getting all these tax questions, Matt. You need to just go also get your CPA. You have all these
That's
other.
right. That's right. That's right. Yeah, good question. The answer is no. So if you're not itemizing your deductions, then you wouldn't need to list that. If you're taking the standard deduction, you wouldn't need to list it or itemize it on your tax return.
Yeah, and recent data I've seen shows that anywhere from 75 to 90% of folks are now taking the standard deduction on their tax returns. So like Matt said, that probably won't be possible. However, in 2026, Collin, you want to tell us, you were kind of nodding your head there, what's coming around the pike here next year?
Yeah, starting in tax year 2026, so it does not apply to this year. Even if you take the standard deduction, you could deduct up to $2,000 if you file jointly, married filing jointly, or $1,000 single. That would just come off the tax return as a true cash donation. So make sure to save those cash donation receipts for next year, up to $1,000 if you're filing single, or up to $2,000 if you're doing married filing jointly.
That is a really important addition. Thank you, Collin, and a change. Of course, if we go back years, we came from times where we were keeping all those receipts because the standard deduction amount was lower. Then in more recent years, most people haven't really had to keep track of that. Well, now, starting in 2026, again, at least for those amounts, you'll definitely want to make sure you take advantage of that if you're doing giving and keep those receipts. Thank you, Collin, for adding that. And of course, as Matt already mentioned, we are not CPAs. We are not attorneys. Make sure you check with those professionals. They will provide you with the tax advice. Our aim today is to just provide educational material for you. Everybody's tax and investment situation and risk tolerance is different, and we understand that. We always want to make sure to remind on that. So thank you so much to our guest speaker, Matt Farmer from the National Christian Foundation. Thank you to Collin Miller, our Director of Planning, and a special shout out to Lauren Wegman, our marketing specialist, who gave us a great presentation. She compiled here and coordinated with Matt and pulled today off. So thank you also to every one of our clients who made time to attend, as well as any guests that might have been on the call today. If you don't mind, we will send out a survey after the event. We want to hear from you. Your feedback is critical to our planning when it comes to webinars like this. We always want to be talking about what's most relevant to you. And so we have taken information that we've received in the past, and it has helped shape the course of our planning on the webinar series that we do. So please take a minute to do that. But thank you so much for your time, your continued business, and we look forward to furthering the generosity and giving conversation with each of you. Have a wonderful day.